The poor man's covered call is one of the best ways for investors to start generating income with options without having to buy 100 shares. This is specifically great for smaller accounts, obviously, people that don't have enough just yet to buy 100 shares, but are trying to grow a big portfolio. So let's go ahead and dive into it. I'm gonna teach you in this video exactly how to deploy poor man's covered calls and the exact strategy you need to be implementing to be successful with this. Now, if you take a look at my portfolio, we're currently just hovering above 660K, and I'm gonna be documenting this portfolio, growing it to 10 million in the next 7 to 10 years. So if you haven't subscribed, be sure to subscribe to see the journey and to follow along on the exact strategies that you could implement to grow your wealth. Now, if you want my free options picks directly to your inbox for free, subscribe to my newsletter down below. That'll be first link in the description. Also, I answer all questions, so if you comment below with any questions, I'm gonna answer you. As well as if you wanna reach out to me personally, see my personal life, go to my Instagram, it's Ryan Hildreth. That'll also be in the link below, and send me a DM. I would love to talk to you. I love talking to everyone that's been watching my videos. So let's go ahead and jump right into it. Now remember, this is not financial advice. This is just me showing you how I've built my wealth with options. So let's go ahead and get into it. The poor man's covered call. This is something that I used to implement when I had a smaller account, and actually just recently put on a new position so that you can see me doing it live in my account. Now, the poor man's covered call consists of a deep in the money call option that expires in 365 days or more, which is called a LEAP option, or a long equity anticipation security, and selling a call against it. Just like you would a covered call against shares, you are selling a call against a long call that you own to create income. So if you look at the diagram next to me, this is a great example. Right here, we have a long 140 call. So let's just say the stock is trading at 150, okay? It's trading at 150. You're super bullish on the stock. You think this thing is gonna go up for at least the foreseeable future, the next few years while we have a bull market. Well, you'd purchase the 140 call. So you purchase that, and then immediately what you could do is to create income every 30 to 45 days, or shorter if you want, but in this instance, we're gonna be going out 30 to 45 days. You're gonna sell a call against your long call, okay? Which basically will help you create income while you're waiting for the stock to go up. And you could do this every single month. Now, what this essentially does is create a synthetic stock position, okay, without having to own 100 shares. So you're basically controlling 100 shares with this long call without having to, pay for 100 shares, maybe half the price or a third of the price. And then you're basically selling a synthetic covered call against it, okay? Usually you would need 100 shares to sell a covered call. But since you purchased a call, you're creating a spread which the brokers allow, okay? This is called a diagonal spread. So you're buying a call down here, deep in the money, and you're selling a shorter duration call against it. Technically, that's a diagonal spread. But by selling the covered call to collect income while you wait for your long call to go up in value, you're essentially capping your gains, okay? So just be aware that because this is a spread, technically, you are capping your upside with the covered call, or the poor man's covered call, to collect income. So just be aware that the stock could rise up very drastically depending on what stock you're doing it on, right? And I would stick with the indexes like SPY or QQQ just as a beginner's example. Like, I would not start with Apple or Nvidia or Tesla or something crazy like that. I would do it on something that's more well diversified, and it's not going to shoot straight up like Tesla does overnight, okay? So you're technically capping your gains if the long call goes up past your short call, but what you could do is roll your short call. And I just uploaded a video like a couple days ago on rolling options. So if you want to check that one out on my channel, it's literally, I just uploaded it not too long ago. But you could essentially roll this covered call, or this poor man's covered call, up and out in time to collect additional income and let your stock continue going up, okay? Now, let's go ahead and jump into the mechanics of the trade. So again, what's cool about this is, doing a traditional covered call or a rich man's covered call, you'd have to buy 100 shares, which is very capital intensive, right? You're up like 100 shares of Apple is going to be $22,000. But you don't need $22,000. You probably only need a couple thousand with a poor man's covered call. So it's a cheaper way and more capital efficient way to generate income from covered calls. Now, what I would do is I would purchase a 70 plus, so 70, 80, 90 delta call on the stock that I'm extremely bullish on. So this is a bullish play, right? We're extremely bullish. So you buy the 70 delta or higher. But the cool part is you don't need capital to buy 100 shares. You just pay the premium for the call option. Then what you do is sell a 15 to 20 delta call 30 to 45 days out against your long call. So your long call position, just pretend like it's your stock position. Obviously it's not. There is risk when buying a call, right? Because it could expire worthless in 365 days. But on QQQ or SPY, something safer like that, on an index, it's most likely not going to do that. So you're going to sell a 15 to 20 delta call against that. If your call gets tested at any point in time with 21 days until expiration left or less, okay, so if there's like 15 days left till expiration, you'll want to manage that position. You will want to roll up the call and up and out for a net credit. Okay, again, there's a rolling options video on my channel, which you can check out. Now let's go ahead and go into a live example. We're gonna log into my account. As you could see, I entered down here on QQQ, I entered a 480 call, okay? This expires in 428 days, so it expires in 2026, which is a long time from now. Currently down on the position because I bought this when QQQ was trading at 513. We're at 508. That's okay. I knew it was going to happen. I just wanted to put on this position for the channel just to kind of see how this moves and so we could track this along together. Now, what you would do to this, okay, is you would immediately go out on the options chain. Let's just go 43 days. I like that. I like going longer duration, okay? And we're gonna go to the 20 delta. We wanna be extra safe when selling a call against a leap and not a stock position because there's nothing to get called away, right? Like if I was selling a call against my 100 shares and the stock goes past my call strike, well, collateral is my 100 shares. Now there's no collateral with a leap, right? There's no, they can't just liquidate your leap to cover your call that you're selling. So you have to be very careful on going out far enough, okay, and only selling a call when QQQ is up. Like today, I would not sell the covered call. I would wait until we have an up day. Maybe we go back up to 511 or 513, and then I would go to the 20 delta call. If you want to play it extra safe, you can go all the way to the 15 delta call. We'll just go to the 18 delta right in the middle. And that's going to give you $234 in income, okay, in 43 days. Now, if we want to go to the 30-day, maybe we want to collect income a little faster, right? Let's just see where the 15 delta call is there, or the 18 delta. The 18 delta would pay us about almost $200, $1.96, right? If you want to go a little bit closer, maybe we go to the 19 or 21 delta, which potentially I wouldn't do that. I would maybe just stick to the 19. That would give you $214 in income while your leap is going up in value, okay? Now let's look at the chart. So 529 is pretty high. If we go down to the chart, we could see that, we had a high of 515 on QQQ. So 529 is a significant ways away. That's all the way up here. Within 30 days, probably not gonna get there. So I would say that you're pretty much safe with this position. Worst case scenario, let's just say that the stock goes all the way up there. Maybe you're down like $300 on the trade. You can go out, 45 to 60 days, okay? And you can roll that call up even higher to collect, enough income to cover that. Maybe we go to the 529, $600, right? To cover that loss. So that's how you do the poor man's covered call. Again, you'll want to do this on the index to be safer. If you do it on like stock like Nvidia, for instance, which is not recommended, I would go shorter duration, maybe 22 days, and I would go 15 delta, no higher, okay? Because 15 delta, you're collecting, almost, and this is a 22-day expiration, you're collecting $157. So the return on capital is huge there. But this stock during earnings, definitely don't don't put on poor man's covered calls during earnings, because this could definitely shoot past that. So that's exactly how to do the poor man's covered call. If you have any questions, leave them down below. If you got value out of this video, press the thumbs up button for the YouTube algorithm. I appreciate you, and I'll see you in the next one. Take care.